equity derivatives and cross-asset at Cantor Fitzgerald, joins us now by phone, trying to bring in all sorts of perspectives here, Eric. We just heard from Marko Klanovic of J.P. Morgan, who is bullish. You are not so much a dip buyer of these markets, are you? You've been expecting a lot of the weakness and I think expect it to keep going. Is that right?
Absolutely, yes. We still remain bearish, and we think there's still downside, to this market. A lot of the around how things are playing out today is sort of, reflecting that. You're seeing a classic, risk-off day today where, bonds are bid, gold is rallying, implied vols in the options market are pumped up, and a lot of the hedge fund crowded names are underperforming. And we think this trend is going to continue because right now we don't see the argument for why you want to own stocks based on the dynamics going on with the Fed, the Russia situation. I think bigger picture is not going to be a material factor over time, but certainly for right now is going to, add to the fears out there. So, overall, we think it's a pretty negative picture, and we think it's hard to present a, bull case for this market right now.
Well, some of the bull cases that we've heard on this program, Eric, include the fact that the economy and earnings are in pretty solid shape, and that we've seen some evidence lately even that they're on solid footing going into this period of volatility, like retail sales, for instance, stronger jobs than what were expected. And we're getting some pretty decent reports from corporate America as well. So do you disagree? Do you think that the recession risk is higher?
So our issue is that the incremental trend of earnings is not favorable. So, this quarter's earnings in the grand scheme of things were okay, but it was actually the worst quarter since the pandemic, and that's been the trend the last few quarters. So we look at the direction and say, okay, incrementally from here around how people are going to trade going forward, the earnings are no longer going to go higher. They're no longer going to surprise to the upside. And the way that stocks are priced right now is they are priced as if we're going to see the incremental, uptick in earnings that we've seen for the past year. And we think that part is over because operating margins have really peaked. They're at levels that we haven't seen in a very long time. And then you add into this the fact that the Fed is tightening into a economic outlook that is still okay, but it is slowing. And that combination incrementally is going to be, I think, will continue to be problematic for stock prices.
So, Eric, how do you think about where stocks should be priced then for this environment if they're pricing in, too high expectations at this point?
So I think you need, if you get into the 38